So let's look at a Money Guy case study where we actually test the numbers using a real policy designed by a real insurance agent.
I had no idea what they're going to do with the information.
If you would have just bought the S&P 500, the broad 500 largest companies in this country, it's annualized almost 11.3%.
Multiple times I told them, like, hey, this is not supposed to replace investing. And then they said it was like a 2% or 1.5% rate of return. And I'm like, this is just bad. Like, why do you always show the worst case scenario? I was just disappointed where in their video, they still compared it to an 8% rate of return in the stock market. And I'm like, well, of course, they focus too much on the insurance policy rather than what infinite banking actually is.
We ran the numbers and we saw that this has a internal rate of return of 3.68%. This looks like it breaks even in year 7, but it could break even in year 6.
Maybe 10 or 20 years.
Yep.
It actually tends to increase your internal rate of return that way as well.
If you don't understand the philosophy and process, it's like, why would you do this? Welcome to the BetterWealth Show.
Happy to be here. Thanks, Caleb.
I really appreciate you reaching up your hand and reaching out and making yourself known. I did a video reacting to the Money Guy show, exposing infinite banking as a scam. And they, use this advisor or a life insurance person behind the scenes. They said, hey, we got this illustration from someone that is pro infinite banking. And so we're like went behind the curtains and we're going to show you a real life example, because one of the things that we've been critical, I think, of people that attack infinite banking is they do all the talking points and then they use typical horrible whole life insurance. And then of course we would all agree, we all agree that this is not good, but they're not usually using an overfunded policy. Now, to their credit, they used an overfunded policy. We're actually going to look at the actual policy that they looked at. And I want to give just context and kudos to you for being willing to have this conversation. I think this will act as a very awesome part 2 to my reaction. And I would love to hear directly from you, the person that sent them illustrations, how you felt like the video went. And I know we both love Brian and Bo. I think they do a phenomenal job. They have an amazing channel. Lots of people follow what they're up to. And I think their information is amazing. When they talk about stuff like this, though, my critique goes up because obviously we know quite a bit about this. We've helped a lot of people, and and sometimes I feel like there's been talking points or there's not a full comprehension of what we're trying to say. So with that, the world's longest intro, Dallin, welcome to the show.
Cool.
So first of all, how long have you been following the Money Guy show, and why did you reach out to them to begin with, to just give them illustrations for them to look at?
Yeah, I can get into that. So I've been following almost a year, more or less, following BetterWealth for about 2. And I've loved their content. It just seems straightforward, easy to follow, and they're not as dogmatic as some of the other finance gurus. They're actual financial advisors. They take questions that are unique to people's situations, but they still have their framework that I think works for about 99% of people. Okay. So I've been a huge fan, but about 4 or 5 months ago, they had just a post that they put out on their different social media channels that had, what is infinite banking? And it was like a carousel post. It showed this is what they say. This is what it actually is. It's just whole life insurance, and whole life insurance is a pretty bad investment. And then they showed, I assume they took some sort of illustration, but they showed about $3,500 each year going in for 30 years for a 30-year-old or a 35-year-old. It's the same. I based this on the same age demographic and such. So, and the illustration that they had, or just the numbers that they broke down, it was 20 years until they broke even. And then they said it was a 2% or 1.5% rate of return. And I'm like, this is just bad. And so I commented on that post as just engaging in the online or Instagram community. Oh no, it was YouTube again. I was like, why do you always show the worst case scenario? That was my comment. It's why do you always show the worst case scenario? This is not what infinite banking is. And so they had one of the content developers comment back and is like, oh, well, this is just what we had. We didn't realize there was a different way to do it. They talked about PUAs, but I'm like, you're not really using them the right way. And so he said, hey, shoot me an email. If you want to send us actual illustrations of how this is supposed to be done, we would love to see how that's supposed to be done. And so I initially tried to match everything, and it's like, yeah, it was a little bit better by overfunding it. But when you're only putting in $3,500 a year, sometimes there's like expenses and whatnot. So I'm like, really, it should be a little bit more. And then I sent other illustrations like, hey, you could also front load it, put more money in earlier. And that just helps just with internal expenses and how it just makes it grow a little bit better. But the idea is that you're putting money into the PUAs from your premium in a high amount rather than just the dividends being PUAs. I think that's what it was on their original example.
Yep. And so you sent them 4 examples, some with front loads, and then they chose the $10,000 example level with a company that I think when you originally reached out, you're like, hey, I could have designed this way better. I think you were just like kind of starting the conversation. Did you think that they were going to take your illustrations and make a whole show out of it? Or did you just want to like get them to think like, hey, there might be other designs out there as it relates to this?
Oh, I had no idea what they're going to do with the information. I did not think they were going to make a whole show about it. So I was very surprised when I saw the YouTube notification, Infinite Banking Exposed. I was like, huh, like that was about 2 months ago. I sent them an illustration. I wonder what happened. And then as they went through it, I noticed that they used a lot of the information that I sent in the email trying to explain it. And and some of their follow-up questions. And then they used the actual numbers. I was like, oh, yep, that was the illustration I sent him. Cool.
Do you, and we're gonna look at the illustration in a second, but what were some of the points that you were trying to make, and what is your initial thoughts on their video that they made when it comes to exposing infinite banking? Like, what are some of the points that you're like, hey, I think they are spot on? What are some of the points that you still feel like, man, I think they're misrepresenting something, or then they might not be understanding the full picture of what I'm trying to say?
Yeah, I thought they did a relatively good job. I thought it was very fair, generally speaking, compared to what is popular in a lot of finance spaces to say about infinite banking and life insurance. And I think they did a pretty good job trying to be open-minded and actually looking at the numbers and the functionality of the different parts of an insurance policy. I think where they fell a little bit flat, though, is they focused too much on the insurance policy rather than what infinite banking actually is. It's not the product, it's how you use the product. And so multiple times I told them like, hey, this is not supposed to replace investing. This is a place to put your cash. This is a place where if you put your money here first, that allows you to capture long-term compounding interest with some other benefits of protection and long-term care and those sorts of things. But if that's all you did, it's probably not the best use of your money. It needs to be a catalyst for other things in your life. And even mentioned, I'm like, hey, Brian's a business owner. He probably does sit on a lot of cash. This might be a good fit for him. This is kind of how it's supposed to be used. And then I was just disappointed where in their video, they still compared it to an 8% rate of return in the stock market. And I'm like, well, of course, that's going to look better on paper. Like, this isn't designed to just be dormant unless it's replacing bonds in a portfolio. So.
Yeah, they should have called their video exposing whole life insurance as an investment. Should you invest in whole life exposed? Because I think we would all agree. The answer is no. The answer is like, don't mix insurance and investments. And I think we would all agree with that. I think where it gets a little bit misunderstanding is like, we never throw high yield savings accounts under the bus. It's like, hey, like I could get 12% in an investment in my high yield savings account gets me only 3 or 4 or maybe 5% at the time of this recording. And we never say like that's a terrible investment, because we don't invest in our high yield savings account. It's a place to store capital. And then when you look at like all the benefits of high yield savings account, it's safe. It earns quite a bit of money. It's liquid. Like those are the 3 core benefits. Well, if you look at life insurance, what are some of the maybe disadvantages? Well, maybe in the first year you don't have all the money that you put in, but you get a better long-term internal rate of return. We're going to look at that in a second. Even in today's high interest rates, that's the case. But like, we're not going to see high yield savings accounts at 5% for the next 30 years. And if we do, life insurance will be far greater. And there's a lot of data to back that up. But even if like we compare like a year ago interest rates, you look at life insurance, internal rate of return trounces the long-term growth that you could get in high yield savings account. But then you talk about all the other benefits. You have a death benefit. You have other chronic illness riders that could act as like you could potentially tap into the death benefit before you die for many reasons. There's creditor protection, but then you're able to use your money throughout your life and get all those benefits compounded. And then there's a lot of research. I have a lot of people on my show that talks about life insurance in retirement enhances the potential income in the future. And so what's the value of having maybe a better bond in your portfolio? So it's like, we're not, and none of this is investments. It's just the reality is, as an asset, as a foundational asset, it's amazing. But it has nothing to do with like the it factor of the growth. It has everything to do with how it enhances everything around, which is a place to store and use, and it's a foundational asset. And I know I'm just re-saying what you're saying, but those are the kind of things where it's like their whole point was, well, okay, let's look at the investment versus money, invested in life insurance, and they look at the rate difference. And I think we would all agree that's like, yes, you're not wrong, but you're using the word infinite banking, and I think you're misrepresenting what many people and why they use that as a foundational asset.
And the explanation they gave was like, well, a lot of our audience, doesn't have $10,000 to put into an insurance policy per year. But if they were to, they would do that instead of investing. And I said, well, I can understand that perspective, but again, like, this isn't supposed to replace your investing. And so if it's not a fit for your situation, don't do it. That's how I look at it. So
I want to go on the record and say I think term insurance is amazing. And I believe that almost everybody make sure you figure out what your life is worth. I know that's could be a rough conversation to maybe have, but like make sure that you're protected and insured. Like, that's straight up, period. And then I would just look at overfunded life insurance as an alternative place to save and use your money. And yeah, I'm not opposed to people putting their money into life insurance and then accelerating debt. I just have to, a lot of times mathematically, we have to understand like, okay, mathematically, this might not be the best thing, but when you bring emotion in and when you start adding out all the other benefits of like what we talked about, you could make the argument that could be a play. But a big message is, I believe that you are your greatest asset, and the best investment you should be making for so many people that are listening to this that can't save $10,000. I would say your best investment is yourself. And as cliche and as fluffy as that sounds, I would say go all in on that, and everything else will make itself. Everything else will do its thing. So that's kind of my 2 cents on that. I think that when you actually look at data, probably 90% of the world should probably not use this. So I mean, again, we could have there might be someone that has the right mindset, great. But I think when you include mindset and understanding, I can't with a conscience say that 90% plus of people should use this. Whereas I think what Dave Ramsey teaches, I do believe is very universal. Like, get an emergency fund, all these things. But at the end of the day, I think the message that we need to be speaking more is like, if you're not happy, figure that out, and like figure out how you can increase more value in the marketplace. And like, you should be investing all in on that. I could care less if it comes from a life insurance policy or a savings account. At the end of the day, life insurance is an amazing foundational asset when you start getting cash flow.
For sure.
All right, so let's jump into the illustration that they used. You showed a couple other ones. You showed a front load, which is an amazing design for a company that you illustrated with. But I'm now looking on the screen, and you put in $10,000 in. I'll pump up my. So you put in $10,000 in. You have cash value available first year, $8,648,000. So we have a liquidity of 86%. So that's pretty good. That's pretty good. And then this looks like it breaks even in year 7, but it could break even in year 6 from a standpoint of like everything's based on today's interest rates, and it's really like last year's interest rates. And so that's interesting. You have an initial death benefit of 1 point, let's just say 200.
Mm-hmm.
Yeah, 200. And then this thing grows, and you have everything stopping at age 65, which is great just from an understanding standpoint. You have a cash value of 531,877. So again, just to be clear, we're not saying like all you should do is put your money and keep it there. Like that's not what we're saying, but that's what they showed in their video. And then the death benefit is almost at 900,000. So this is a good example. I want to just commend you for like an easy to understand example. It's a good example. We ran the numbers, and we saw that this has a internal rate of return of 3.68%. And so again, this is not based on like the current, like last year's reflection on interest rates. This is mainly looking at still like these companies project very conservatively. So want to get your thoughts on that. What would you have done differently, or you stand by this design from a standpoint of cash flows going in and out?
Well, if I known that they were going to present it as like best case scenario, I probably would have changed it a little bit. This is 1/3 base insurance, 2/3 PUA. And I thought they did a good job explaining how that works in the video and how loans work and all of that, but they kind of missed the mark of like what's the purpose of doing that, which is to increase your liquidity early and your break even, your internal rate of return. So I could have definitely pulled that up a teeny bit on the PUA percentage there. And then I probably just wouldn't have paid in for 30 years. Like that's just a long period of time. Most of the examples that I even mentioned that to them, was like 30 years is kind of a long time. Most of the examples, if you do 10 or 20 years, actually tends to increase your internal rate of return that way as well. Well,
and this is, again, you can start with 10 years, but like, let's just look at this. In year 11, in this example, your cash value is, 100, 108, we'll just say for easy math, and you're putting in $10,000, and your cash value increases by more than 10. It's, back in the Mac, it's like 14. Okay. And so again, you could say, you don't have to pay, but it's like, if you can put money into a machine and you get more than that money back, and there's access and liquidity, again, that's just an interesting perspective. At year 30, you're putting in $10,000, and your cash value increases by 30 grand. So again, playing devil's advocate, it's like, why are we stopping at age 30? We're stopping because, again, if you don't understand the philosophy and process, it's like, why would you do this? But and people hate seeing it all the way till they die, because there's this part of us that like wants to quote unquote retire. But it's like, as long as you have cash flow, why wouldn't you, if you have a foundational asset? Again, this is not an investment. We have to be thinking about this as a foundational asset. It just gets you start thinking. And again, it's hard to articulate that in an email, but what are your thoughts on what I shared?
Because like, as we mentioned at the start, the life insurance is more than just a place to put your money. It's not just a growth engine. And so when you put it in that perspective, if you have that cash flow and you're actually using it to continue to grow, I know a lot of people say that after your first few years, life insurance is a great place to put your money because it's super efficient. And you just showed that. It was year 4 when you get more increase in cash value than what you're putting into it. So,
I also want to just point something out. Again, this is if you look at the initial death benefit of, let's just say it's 200, and like, let's say at the end at year 30 it's 900. What Dave Ramsey will say is, your death benefit gets stolen. Like, they steal your cash value. And it's like, so you have $500,000 plus some cash value that you can use for whatever you want. And like, let's just say you die and you don't use a single penny kind of deal. Well, you're getting a death benefit of, it's over 200,000 more. It's you can't say that they stole your death benefit. And so that's where, again, in maybe typical advice, the death benefit doesn't increase, and you could use that as a talking point. But even in the policies that we design, the death benefit increases every year, and in many cases, the day that you quote unquote die, it's not going to be less than your initial, even with the cash value buildup. And so that's just another example that I don't think they mentioned, but is a common talking point. I think even in this illustration, we can use that as an example.
As far as protection goes, we started with you should get term insurance for your protection needs. And I totally agree. The one thing in the video that I was like, of course they went there. It's like, for $10,000, you're buying $200,000 of insurance. Like, why would you do that? It's like, well, no, that's not why I'm doing this. I also have $500,000 of term insurance for extremely cheap. Like that's not the reason why I'm doing this. It's like, it's so that I can have access to that cash value. And if I were to die, I still have a death benefit, which is great. Awesome. It provides a lot of benefits. So.
So let's go back, and we're actually going to look at these numbers because I threw out a 3.68% rate of return, and we actually have an internal calculator that anyone can use. We'll have this available down below. It's a very basic calculator, by the way. We're starting humbly here, but I just took a 3.5% rate of return. We could run it at 4, but let's just take a 3.5% internal rate of return. This is the actual rate of return that you're going to get. And again, it's easy to say, well, I could put my money in stocks and all that stuff. And hopefully at this time, people understand that, yes, but you have the ability to use your money. And yes, there's an interest cost, and we can talk all day long about that. You have to make sure that whatever the cost of capital is to use, you're getting a greater return, but you can have a dollar doing two things in a life insurance policy. And the whole idea is to have your money in motion in a sense. And so we'll just say you have a 3.5% rate of return. That's a pretty great if you think about the next 30 years. I know interest rates are artificially high right now, but I don't think they're going to stay this high for next 30 years. So 3.5%, like that's pretty good, especially 2 or 3 years ago, like way better than a savings account. Okay. But the 3.5%, if we're comparing it to a high yield savings account, like what is something that a high yield savings account has? Well, it's taxes. And so we have to factor in taxes. Now, it's ordinary income. Some people might pay 0 taxes. Some people may pay a lot of taxes. You might be in California and being super, like the people that especially are, interested in this usually have a high tax rate. And so this really affects them. So even if we put 15%, now your 3.5% life insurance that you're getting in your policy, you now have to earn over 4% every single year just to keep up. Now, what if we did, 30%? Now, people might say, like, why 30%? I don't know. I just came up with the number. And if you look at state and you look at federal, depending on where you are with what income, this could be super low already. It all depends. Now you need to earn 5% every single year just to keep up. Now, all the other benefits that life insurance gives you, death benefit, the chronic illness rider, the privacy, the access to cash, like all those things, what a lot of times people say is, well, what about buy term and invest a difference? Well, what happens when we're buying term insurance? That's actual cost of money that we're using to purchase. It's an actual expense because we hope it doesn't ever have to convert. But what we're actually doing is we're spending money for that extra protection. So the management fee is just an example of saying, well, if we're going to buy term insurance, let's use that as like how much percentage is that going to cost out of our pocket to buy term insurance? 1%, 2%, 3% from a standpoint of like what it would cost to buy term and invest a difference. Because if you buy term insurance, you literally have less money to invest. And so just that 1% management fee would be, now you'd have to earn over 6%. But now when you're starting to buy costs of insurance and all those as it relates to life insurance, like let's just say a 3% management fee represents term insurance and all the other benefits that life insurance gets you, not just the internal rate of return. Like we're not even talking about potential benefits of like bond portfolio and other, because I believe life insurance when set up properly is probably better than a bond from as it relates to your portfolio. Now we're saying you need to earn almost 8% every single year in life insurance. And I want to be very, very clear. I'm not telling you whole life insurance gets you 8%. I'm not saying like that's not correct at all. I am saying that we have to understand that taxes and other costs need to be kept into the equation. And I'm saying in this example, a 30% tax rate and a 3% fee, which represents cost of insurance and all the other things, you're now looking at the boring old life insurance policy that you showed them. You in an alternative account with some other factors, now you have to earn over 8%. And you and I both know that if you want to have an opportunity, if you believe so greatly in the S&P 500 or whatnot, you can utilize your cash value to be able to do that. But you realize all the benefits of life insurance, not just the internal rate of return, but all the benefits of permanent life insurance now in the future. I'll let you speak to that because I don't want to misrepresent this in any way. I just want to like show that sometimes when we look at just the rate of return, it doesn't tell the whole story, because it's like comparing an apple versus a clementine. And it's like, okay, it's easy to think, but it's like you don't have the full story there. And that's what can be frustrating sometimes.
Mm-hmm. Again, I think you just got to remember that this is a cash vehicle. And so 3.5% on cash just to start with is actually pretty decent. Like, you can't look at a short-term scenario over a long period of time. So yes, we're at a 4.6% is what my high yield savings account gets, and I'm still putting money into that, but I don't know how long that's going to last, right? So just right off the bat, 3.5% is actually decent for cash. Add in the tax component, then it's a lot more powerful, especially like you mentioned, people who have lots of cash that maybe are looking for a way to save on taxes on their cash savings. This is a fantastic place to do that. Again, that jumped it up. What was it? Like 1 to 1.5% just with the tax savings right there, right?
Yep. It went from 3.5 to 5. And again, because our calculator is very basic, your technical internal rate of return was 3.7 essentially.
Yeah.
But because we have 0.5% increments, this is just for educational purposes only. But I just wanted to share with people that there's better ways to potentially look at this.
Because I just think, okay, you had $200,000 just sitting in your high yield savings account. That's a pretty decent tax chunk every year. So that's a big deal. And then that management fee, that could represent a lot of things. It could literally mean a management fee on your investments with inside your 401k, inside your investment advisor fee, those sorts of things. But then you also add on the cost of term insurance, probably anywhere between that 0.5% to 1%. And then if you add to buy long-term care insurance on top of that, it does just add a lot of things to it. And so I totally agree. You can't just look at what the cash value is growing at. You got to look at what can this asset do for you in your life.
Exactly. That's well said. You talked about long-term care insurance, and I know that you and I both wouldn't say that the chronic illness rider is a long-term care rider. Some of the cases you can,
similar, not the same. Yeah.
But why don't you explain in your opinion how it's similar? Because I'm sure you have clients, we have clients, and I'm not saying that this is right, but choose not to get long-term care insurance because they have life insurance with chronic illness riders and all. And so explain why some of your clients might not pay for long-term care and instead feel good because they have permanent life insurance.
I just think it's a more efficient use of their money, just to be completely honest. So when, say, we work with a lot of retirement clients that are pre-retirees or during retirement, and straight up long-term care insurance can be kind of expensive at that age. But then you could say, well, so is life insurance. But say they reposition some of their money into their life insurance policy there. Now, if they don't actually use that long-term care insurance, it's not a pure expense. They have that cash value growing. They can use that to fund some of their expenses, especially, say, down years in the market. They have that cash buffer there. But then it actually happens. They do end up getting confined into a nursing home. They can't, do one of the 6 or 2 of the 6 activities of daily living. So eating, bathing, moving, clothing, those sorts of things. Or really, really poignant one is, say, they got diagnosed with cancer. Now, instead of having $500,000 that they would have saved for a medical expense, now they have access to almost $900,000 to go and get treatment for that. And so it just gives them a lot more flexibility and options. And if, heaven forbid, they actually get into that situation and they need it, to the life insurance company, they're saying, well, this death benefit was already going to be paid. why not let you access that early if it can help enhance the quality of your life before you pass?
Yeah.
So
Yeah. Because we're dealing with actuarial science, because that's already baked in, it's very little. It's not as big of a deal because they're already going to pay that eventually. Like you're near the
mhm.
end of your life, and so it's a way to quote unquote accelerate your death benefit. And there's a cost to that. But the point is, there's options, and I'm a fan of increase your options, because the person that has more options, I just believe, has just a better life than the person that has limited options. And I actually know somebody who is alive, is literally alive, because of the accelerated benefits of a life insurance policy, because they got a diagnosis that was very scary, that didn't look very good, and they used their accelerated benefit rider to do alternative treatment, and they're alive, and they believe they're alive because of it. Again, I'm this is we're not we're not giving financial advice, and we're definitely not giving medical advice. So, but the
Sure.
point that I'm trying to make is, like, it just gets you thinking. It's like, what is the rate of return of that? I don't know.
Can't
I think
really
it's
put a
really
number on
powerful
it.
when you understand it as a multidimensional asset.
I think it's just the more I'm studying uh, personal finance, financial planning, retirement planning, I just think that it's either a misunderstood or just well, I think it's very underutilized life insurance. One of the reasons is for that additional accelerated benefit, because it's like, sure, you can save your money for a health
Yep.
expense. I think the stat saying you would, on average, throughout your retirement, need $300,000 for health expenses. Sure, you can save some of that for regular, but if you got a big expense like that or a big diagnosis, that's just way more efficient to have
Yep.
those options and access. So.
Yep. Well, Dallin, I thank you for coming on the show. Thank you for reaching out. And I just want to say, if you are somebody that wants to come on our show, if there's perspectives that you have, if you have stories about or questions about your own financial life, please reach out. Dallin, I really appreciate you being proactive in that. Is there anything else that you want to say? The floor is yours, but I just want to hand it over. Any other points that you want to make, or questions that you have for me, or just encouragement that you have for the people watching or listening to this?
Yeah. First thing, I want to thank you for the opportunity. I've been a fan for a while, and I got into the life insurance space just kind of a happenstance. Just my company was like, "Hey, we're gonna sell life insurance," but I realized that this has real life implications for people. So I wanted to make sure I understood these things before I just dove in and sold it. And so I want to credit you and Dom and a lot of people to giving me a lot of clarity on that. And then B, this is just a tool, people. Don't make it out to be more than it is. It's a tool in your life. It can be a foundation. It can help enhance a lot of things in your life, but like, it's just one thing you can do. You said before, you're your greatest asset. Figure out how you can find value and provide value. If life insurance enhances that, great. If it doesn't, no big deal. Figure out a system that works for you, where you can A, prepare for your future and your current needs, and B, increase your value, then you should be just fine. So,
Dallin, I appreciate the wisdom. I appreciate you following and just helping us promote this message. Thank you. And I want to just say a sincere thank you to all of you that literally make what we do possible. Like, thank you. We would not have a show. We wouldn't have any influence if it wasn't for people that listened and shared these videos. And so if there's anything that we can do for you, Dallin, let us know. And if there's anything that we can do for the people watching, like, we got resources down below. And just know that when you subscribe, when you share, when you comment, it helps us get this message out. And I think this is a small example of what's to come. So I hope that I can sit down with the Money Guy Show and just share maybe a different perspective. And I guarantee this, that I think both parties will realize that we have so much more in common that we think about than maybe they think. And I probably agree with 99% of what they're saying, and they probably would agree with majority of the things that I say. And I think there's a lot of cool thing. I think it's pretty powerful when two parties can sit down that maybe disagree on some things, but talk and be able to have an amazing conversation. So I'm hoping to have them on the show to do that very thing.
That would be fantastic. I would definitely watch that. So
Okay, awesome. Dallin, thank you, and have an amazing rest of your day.
thanks. See ya.